What's going on, guys, and welcome back to another video. In today's video, as one of the three portfolio pies that I have on my Trading 212 app is solely focused on ETFs, I'm going to do a review of the S&P 500 index, and more specifically the VUSA index, which is the Vanguard S&P 500 ETF on the Trading 212 app. The S&P 500 index is the market index that measures the stock performance of 500 large companies listed on the stock exchanges in the United States. It is one of the most commonly followed equity indexes. The S&P 500 market cap is an impressive $27 trillion as of June 30th, 2020. It is on the current exchanges of the New York Stock Exchange, the Nasdaq, and the BZX exchange. Its weighted method is free float capitalization weighted, and it was founded 63 years ago on the 4th of March 1957 and currently has 505 constituents. But before we go any further in today's video, I just want to say thank you very much to the 230 people that have currently subscribed to this channel, and if you haven't done so already, I'd be really appreciative if you consider subscribing to this channel to help this channel grow and to improve the video quality over time. So as stated at the beginning of this video, as I have holdings in the VUSA index, which is on the London Stock Exchange, I will be focusing on this form of the S&P 500 in today's video. So as stated, the Vanguard S&P 500 is on the LSE or the London Stock Exchange, and it has ticker VUSA. Its currency obviously is in GBP as it is on the London Stock Exchange, and at time of recording it cost £50.29 per NAV. We can see from the 1 year chart on Yahoo Finance that, like every other company, and as this tracks 500 different diversified sectors, it had a crash like every other individual company in the middle of March. But as I said, as it's diversified across all sectors and it includes over 500 companies, it's handy to see that it has continued to go on an upward trajectory ever since the crash in March, and it's up to all-time highs this year so far at over $50 a share. In terms of some brief characteristics of the S&P 500, it currently holds 505, and at this stage it's up to 506 companies because of the new additions. Its market median cap is 143.8 billion. The price to earnings ratio is 25.7 times. The price ratio is 3.5 times. 19.6% return on equity, and earnings on growth rate is 14.3%. Their turnover rate as of the 31st of July 2020 was 2.9%. In terms of performance overview, on the 1 year total, it is up 8.17%, and on the 3 year daily total return is up 11.26%. On the 1 month chart, it is up 2.16%. 3 months, it's up 16.89%. On the 1 year, as stated, it is up 6.51%. 3 years, it's up 10.01%, and 5 years, it is up 10.15%. In terms of the S&P 500 calculation formula for weighting, the S&P 500 uses market capitalization weighting method, giving a higher percentage allocation to companies with larger market capitalization. So the company weighting in the S&P is equal to the company market cap divided by the total of all market caps. As stated, the S&P 500 is diversified across all sectors, and on screen we can see the weighted exposure per sector. In the information technology sector, the VUSA ticker is 27.5% in the IT sector. In the healthcare sector, they are 14.6% weighted. Consumer discretionary is 11.2%. Communication services is 10.9%. In the financials, it is just under 10% at 9.9. 7.8% of the weighted is in the industrial sector. In the consumer staples, it is 7% weighted. Utilities is 3.1%. In real estate, it is 2.8%. Materials, 2.6%. And in the energy sector, it is 2.5% of the weighted allocated to it. So just to look at the market calculation of the weighted average of the S&P 500, I just want to look at a small bit more detail in this. So there's 4 steps. Firstly, calculate the total market cap for the index by adding all the market caps of the individual companies. 2, The weighting of each company in the index is calculated by taking the company's market capitalization and dividing it by the total market cap of the index. 3. For review, the market capitalization of a company is calculated by taking the current stock price and multiplying it by the company's outstanding shares. And 4. Fortunately, the total market cap for the S&P as well as the market caps of the individual companies is published frequently on financial websites, saving investors the need to calculate them themselves. So it will really take the hassle out of all these calculations for the standard investor. As there is over 500 companies on this index, it would probably take a few hours to go through all of these companies overall. So just to keep this video short and sweet, we will look at the top 20 companies that are on the S&P 500. The majority of the top 10 weighted companies on the index are in the IT sector. So Apple has a 6.39%, Microsoft is 5.74%, next up is Amazon, then we have Facebook, we have Alphabet or Google Class A and C, Johnson& Johnson, Berkshire Hathaway Class B, Procter & Gamble, Visa makes up the 10th spot. The 11th highest weighted company on the S&P 500 is in the financial sector in the form of JP Morgan and Chase. Next up is United Health Group, then Home Depot, MasterCard, Nvidia Corp, Verizon Communications, PayPal, Netflix, Adobe, and 20th position is Pfizer Incorporated. So, with everything else in life, there is also limitations to the S&P 500 index. One of the limitations to the S&P and other indexes is that the market cap weighted arises when stocks in the index become overvalued, meaning they rise higher than their fundamental warrant. If a stock has a heavy weighting in the index while being overvalued, the stock typically inflates the overall value or price of the index. Therefore, a rising market cap of a company isn't necessarily indicative of a company's fundamentals, but rather it reflects the stock's increase in value relative to shares outstanding. As a result, equal weighted indexes have become increasingly popular, whereby each company's stock price movements have an equal impact on the index. While researching the S&P 500, I've also noticed that there is a lot of news articles coming out that they feel that the S&P 500 is at its peak and that there could be a true sell-off coming up. There's articles, for example, on madmoney.com where Jim Cramer breaks down how an S&P 500 climb could be followed by a truly savage sell-off. Another article or topic that grabbed the highlight also in the last few days on the financial markets is the exclusion of Tesla from the S&P 500. So on such sites as Newswatch, they stated in bold writing that the S&P 500 added 3 companies and they excluded Tesla, which analysts described as a bit of a shocker. So with all that being said, that brings the end to today's video. Please like, subscribe, and more importantly, comment below on your thoughts and views on the S&P 500 index as an investment. Do you feel that it's way too over-diversified as it now has over 500 companies on their ETF? Or are you the type of investor that much prefers to be able to sleep at night knowing that you're fully diversified across the US stock market and that you'd much prefer to get on average a 10% annual gain from the ETF instead of having to pick stocks individually yourself with the hope of increasing over the 10% mark? Obviously, the main benefit of holding the ETF of the S&P 500 is that there is little to no thought you have to put in yourself as an individual investor. In my own opinion, I believe you should have the ETF in your own portfolio. However, you should also have individually stocks picked out, like I do, for example, in my growth stock portfolio and in my dividend investment portfolio. So that being said, thanks very much for watching today's video, and I will see you guys in the next video.